One of the most important things about a business, if not the most important, because without this single thing, there's no real business actually. And sometimes, it could even make the difference between successful and unsuccessful companies. Did you guess that right? We're talking about sales.
As investors, we always want to find the best companies, or as Warren Buffett says, wonderful businesses that we can invest in. And at the end of the day, it all comes to the money the company produces, what they keep, and how effectively they manage it to make it grow. To know this, we use the income statement. In this video, we're going to talk about this statement, how to read it, and what it can tell us about a business. If you want to start investing, this is something you definitely want to take a look at, along with the other two statements, which are cash flow statement and balance sheet, for which I also have videos in my channel. I'll leave them here for you and in the description below. So let's begin.
This shows us the money the business generates, how they manage it, and the profits they're left with after expenditures for a specific period. I'm going to give you a couple examples with two different companies using Morningstar. We'll start with Apple, which has a very good income statement, and then we'll move on to eBay, which has been struggling a bit with its numbers lately. For Morningstar, let's first look for the company to analyze. Once you have, let's go to Financials, which is where you'll find all three statements. Here you can actually select the one you want to look at, in our case, the income statement, and then click on this Expand Detailed View option to see the entire thing. So here we are, and just for you to have a better understanding of the structure of the statement and where these numbers come from before we get into the definition of each thing, you can see that there is a column for each year's results, and also this one that says TTM. So TTM will show the results of the last 12 consecutive months, which makes perfect sense because when you go to the quarterly reports clicking here, and you add the last 4 quarters, which are 12 months altogether, of course, we get the same result as TTM. Now, going back to the annual report, these 394 billion, and by the way, these are billions because as it says here, all these figures are shortened by 6 zeros, so beware of that. So this number represents how Apple closed its latest fiscal year for 2022. But where does that figure come from? Let's go back to the quarterly reports to find out. This time, instead of taking the last 12 consecutive months or the last 4 consecutive quarters as we did for TTM, we will not consider these two because they belong to 2023. But just take the 4 quarters that were released during 2022 fiscal year. And if you add them all together, we will get the 394 billion figure. So that is the difference between TTM and the annual results. While the first one tracks the last 12 consecutive months, the others show you the results that the company had on each fiscal year. As an extra tip, remember not to get confused between fiscal years and regular calendar years. Some companies' fiscal year begins in January, so it's a little more simple to keep a track on it because it's like a regular calendar year. But for some others, and we can take Apple's particular case, Apple's fiscal year begins in September until September of the following year. In other words, the quarter they release on December of a specific year, let's say 2021, which contains October, November, and December results, is actually the first quarter of the next fiscal year, in this case 2022, because the previous one had ended in September. Thus, the quarterly report released on December 2022 for Apple is actually the first quarter of 2023 fiscal year, and so on. I hope that's clear. So now that you have a better understanding of where these numbers come from and how this statement is structured, let's begin reviewing our income statement. Let's switch back to the yearly report, and we'll focus on this TTM column that has the latest numbers. The income statement starts with the total revenue. This is basically what the business raised in sales for a specific year from its normal operations. Apple, for instance, has generated a total revenue of roughly 384 billion in the past 12 months. Cost of revenue refers to the expenses the business had that have to do with manufacturing, production, and distribution. For them, we can assume this is mostly cell phones and other devices manufacturing, the cost of shipping them to the different stores around the world and deliver them to the customer's hands, raw materials used to make them like plastic and aluminum, and labor salaries, etc. So they spend 217 billion. Gross profit is the amount left from their total revenue after costs of production, manufacturing, and distribution of their service. So total revenue minus cost of revenue equals gross profit. Operating income or expenses. In this case, these are all expenses because they're negative. And it refers to the expenses the business has other than manufacturing and distributing their product. This, as we can see, is divided into general, administrative expenses, and research and development. Examples of general, administrative expenses are salaries, subscriptions, rents, marketing expenses, and even the depreciation that their assets have. So, what is the actual difference between operating income or expense and cost of revenue, also referred to as cost of sales? As mentioned, they both include salaries, for example, but here's how they actually differ from each other. Apple needs to buy raw materials. They have a lot of factory workers too, and expensive equipment in those factories to turn those raw materials into devices. They also need people to transport their final products. But once a product hits the store, you still need employees to assist the clients coming in to finally get it to the customer's hands. These are all costs of revenue, because are expenses that you find along the way, from the moment the product is manufactured until it's delivered and sold to the customer. Now, operating expenses are the other overhead expenses that are still necessary so the business can function, but are not in between the process from production until delivery and selling. For example, the money invested in marketing to promote their brand, the rents they pay for the spaces where the offices or stores are located, or the salaries they pay to their lawyers or human resources employees, which are not as involved in the production and selling process as the workers from the stores or the factories are. This is why they both include salaries, but it will be categorized depending on the role you have in the company, whether it's a cost of revenue or an operational expense. Research and development is a very important number two that you want to see growing. This is what the business invests in innovation, improving their current products, launching new products, etc. If a business invests a considerable amount here, it shows that they have plans to grow more in the future, which is what keeps a company above competitors and basically in business. Small, young companies, especially in a competitive sector like technology, should allocate a considerable amount of money here to grow in their sector, and big companies like Apple to maintain their leading position. So they invested $25 billion on marketing and general expenses and $29 billion in research and development, for a total operating expense of around $54 billion. Operating profit or loss is the amount left from the company's gross profit after general and administrative expenses. So you get it by taking the gross profit minus operating expenses. Another way to see operating profit or loss is what is left from their total revenue after all costs of revenue and operating expenses. In their case, after operating expenses, they kept roughly $112 billion as profit. The operational loss happens when the operating expenses are higher than the gross profit, meaning the money that the business spent on salaries, rents, marketing, etc., surpasses the amount they were left with after cost of revenue. So ideally, we always need to make sure this expense is lower than our gross profit amount. We now get into the non-operating section of this statement. It differs from operating because while this second represents the expenses we have already gone through that are directly related to the business operations, like payroll, research and development, reparations to their machinery, etc., non-operating represents gains or losses not related to their services directly. For example, if Apple owns stocks in another company and they increase in value, making a profit for Apple, either realized that they sell them or unrealized that they just hold them. Just like they can decrease in value, making Apple lose money. But either way, that profit or loss does not come from Apple's main operational activities, but it depends on the performance of this third-party business they invested in. This also applies when companies get a loan to fund a project. Even though this is money coming into the business, it wasn't raised from Apple's main operational activities either, but from a bank that lent them the money, or from investors if they start selling bonds. However, because it's still money from the business being used and it still affects their numbers in a positive or negative way, it has to be reported in the income statement as non-operational activities. Here it shows the interest income and expenses. This in the expense section is the amount of interest the company paid, mostly on borrowings they have taken either from banks or bond buyers, or maybe supplies they have failed to pay their providers. And the income section refers to the interest the company was paid. So the interest paid are subtracted from the ones received and gives us this net figure of minus 239 million because they paid more interest than they received for this period. And for other non-operating income or expense, they also report a loss of minus 592 million. And as mentioned, this is simply money that they lost on things that are not related to their services directly. Their total non-operating expense was 831 million, between interest payments and some other non-operational losses. Pre-tax income is the amount after all expenditures the company has before getting into tax payments. So if we take this operating income minus the total non-operating expenses, it equals pre-tax income. And finally, tax provision is what the company estimates they will have to pay in income taxes. So from this profit of 111 billion, they estimate their tax payment will be 16 billion. So we subtract it to get our net income. This net income we see here is what is actually left in net profits for shareholders. So from the total revenue of almost 384 billion they generated, these 94 billion are the actual profits, and the number we as investors want to pay close attention to, as we want it to increase over time. So of course you need to review a lot more than just the income statement to determine if a certain investment makes sense. But based on this one, Apple is a company you could consider investing in. It's been fairly consistent. But remember, it is in the expenses where you can see how efficient their money management is. And if you take a closer look at their gross profits, operating income, and net income, these figures have been growing over time, which is a good sign as they're able to keep more of that revenue as net profits. Apple is also known for being a very innovative company, so it is not surprised that they seem to care and allocate a lot of their money into the research and development area. And since innovation goes hand in hand with sales and growth, when I see this, what it means to me as an Apple investor is that they will continue to come up with new things. And most importantly, after all expenses, the final net income is not only on the profitable side, but it's a good part of total revenue. Their latest quarters have not been that good, unfortunately, as you can see in their trailing 12 months. And this is the type of thing you as an investor need to watch out for, and do your own research as to why numbers have been down to identify the issue and take your decisions accordingly. But overall, I would not consider this a bad income statement at all.
If a company is not keeping much or any of their revenue, meaning they end up with a negative net income for stockholders, or there is a big gap between what they generate and what they're left with at the end, they need to evaluate why this is happening. If it has very high costs of revenue, they need to find a way to reduce manufacturing and distribution costs without affecting the sales, and that could be difficult to make. On the other hand, if most of the expenses are allocated into general and administrative expenses, they need to reduce costs in rents, marketing, and in some cases even layoffs depending on how bad the situation is.
You can also calculate gross margins and operating margins using the income statement. Well, gross margin, which you get by dividing gross profit with total revenue times 100, gives you the percentage the business keeps from their total revenue after cost of revenue. Operating margin, on the other hand, gives you the percentage kept by the company from its revenue, but after all expenses before taxes and non-operating expenses. You get it by dividing operating income with total revenue times 100. Both of these will give you a reference of how profitable a company is per each dollar of sales. So the higher the percentage is, the more money the business keeps from each dollar sold. For example, Company X produces $10 million in revenue and has a cost of revenue and a gross profit of $5 million. So your gross margin will be 50%. In other words, the company keeps 50 cents per each dollar sold, or $5 million from those $10 million generated. Operating income after all general costs for the same company ended up being $3 million. So your operating margin will be 30%, meaning after all costs of revenue and operating expenses, the business is able to keep 30 cents of each dollar sold, or $3 million out of those $10 million total revenue. As you can see, a high gross margin tells you the company will have enough money left to cover general, administrative, and research and development expenses. And a high operating margin is a sign of efficient money management, as the business retains a good portion of its revenue as profit before getting into expenses they can't control, like taxes and interest. For Apple, the gross margin this year is 43%. And when you do the same calculation for previous years, you'll notice it's been increasing over time, which is great. And operating margin is currently at 29%, which has also increased year after year, with the exception of the last 12 months where it decreased, but not significantly.
The right number for these margins heavily depends on the industry, as each sector has its own average, which is why it is very important for you to compare this metric only with similar companies in the same industry or the same company in previous years. Some businesses have very low costs of revenue and therefore higher gross margins because they demand less money than manufacturing and distribution than others, thus being able to keep more of the revenue. You can't compare Tesla's gross margin because they demand a lot of manufacturing and distribution costs with Salesforce, for example, which is more of a service-based company. And the same with operating margins. Some companies in the tech sector will need a higher marketing and research and development investment than others in different industries. But generally, a 15% operating margin is considered okay, where gross margins are usually higher. You'll find several companies that have very good revenue, but when you look at the costs, some of them even have operating losses, which leads to my next sample using eBay.
eBay has been struggling lately with its numbers. Now, let's review their income statement and see the differences it has with Apple's. First thing we notice, sales or revenue has been up and down since 2018, which is just as far as Morningstar goes, but it hasn't shown any signs of growth. Instead, it's been moving almost within the same range for years. In the past 12 months, they've generated less than what they did back in 2018. Now, you would expect a company to grow over time. So if they have the same results they used to have several years ago, that is not good. Let's take a look at their expenses. Cost of revenue has been slowly increasing in the past few years, so they're getting less and less gross profit in the end. When it comes to operating expenses, notice how this income statement is a little more detailed than the Apple one. Here they separate marketing expenses and the depreciation their assets have from general and administrative, so you can see exactly how much each represents. It also shows us their provisions, which is also part of operational expenses. And what this is money that the business separates for future anticipated expenses. So let's say the business has inventory that has reached their useful life and can't be sold, so they need to make up for those losses. Companies might also have pension provisions, estimating the amount of people who will retire in the near future so they can cover those costs. Or they probably made sales on credit and they make an estimation of the ones that might get to default because not all customers will pay back and the debt must be written off. So this fund is used to cover those expenses. Provisions for this reason are included in the balance sheet as part of liabilities because it's money that will be used in the future to cover eventual costs. And just so you know, this is one of those numbers that is good for companies to have because they're setting money aside for future expenses, so they're being conservative in some way. But at the same time, you do not want it to be too high. Firstly, because it leads us to less revenue being kept by the company as profit. Not to mention, that could be a sign of big liabilities ahead. But also, because sometimes companies fail in their provision estimations, saving a lot more than they actually needed to. So this extra money that was left untouched could have been used more productively. This year, $324 million were set aside as provisions for eBay. And down here, we have the total operating expense, which we take out from our gross profit to get the operating profit or loss, as we already know. So in the past 12 months, this was their total operating expense of $4.9 billion. So we subtract it from the gross profit of $7 billion, and we're left with around $2.2 billion operating income before getting into non-operating income or expenses. Under non-operating, this income statement also goes further into what those other gains and losses were compared to Apple's statement. You can see a lot of components we did not have in the previous company. So let's take the time to define each while we review this so you already know what they mean in case you see them in the future when you're analyzing other companies' income statements. And just so you don't lose track, this whole section I'm pointing out is a breakdown of all the non-operational expenses. So let's get into it. We have the interest paid and received, which we've already covered. So they paid $200 million on interest minus $73 million interest income, losing roughly $126 million. Now, the reason I took out this positive $73 million that is in a different column from this negative $199 million is because since we have nothing reported here, this might be because in their latest quarters, they have not realized any interest income, so it hasn't changed. And remember, TTM will track the past 12 months, so these $73 million are still within that time frame. We also have the net investment income or loss, which is money from selling securities or liquidating investments. So they have lost around $290 million on investments in the past 12 months. The gain or loss on foreign currency exchange happens when a company buys or sells assets or goods to a customer located in a different country that therefore uses a different currency. So when these assets or goods that were purchased are invoiced, the value of that invoice will vary as both currencies fluctuate. Imagine a US company sells goods to a European one for, say, €1 million. So they invoice them for that amount. By the time the invoice was issued, €1 was equivalent to $2. So you could say the value of that invoice was $2 million home currency for the seller. Suppose it is paid a month later, but now €1 is equivalent to $3. So the foreign currency is stronger compared to our initial exchange rate. Therefore, they will have a gain on this transaction because the value of the invoice is now $3 million. On the other hand, if by the time the invoice is paid, €1 is equivalent to, let's say, $1.50, they will have a loss of $500,000. Basically, because it was issued considering the exchange rate of $2 per each euro initially. So they recently lost $3 million in currency exchanges. Gains and losses on derivatives. So this is kind of a complete different topic to cover here, but in a nutshell, derivatives are financial contracts that are valued based on an underlying asset. Examples of these could be CFDs, options, and future contracts. If you want to find more information about derivatives, you can go to my options and futures video, which I'll leave in the description below. They haven't reported any derivatives gains nor losses recently. Then we have the total net investment income or loss. And notice how the same thing happens here with TTM. There's no gain or loss on foreign currency exchange reported here. So we just take this negative $3 million that is still within that 12-month time frame that TTM covers, minus this figure for a total loss of $293 million. They don't have any business disposals reported here, but just to briefly explain you what it is as well, it usually happens after the sale of a parent company and its subsidiaries, usually done by a larger corporation that no longer has equity interest in it, and therefore won't continue to be part of the corporate's group. And finally, these are other non-operating income or expenses they had, but they are not reported in this income statement. So after all these non-operating activities we've reviewed, their total non-operating expense, which you get by taking this negative $293 million they lost on investments, and this negative $126 million lost on interest payments, was $419 million, which has shown some improvement compared to last year's almost $4 billion expense. They also went from a negative $1.6 billion pre-tax income to a positive $1.7 billion, which is great actually. Remember, you get pre-tax income by taking your gross profit plus operating income or expense plus non-operating income or expense. Net income before extraordinary items and discontinued operations. So let's begin with discontinued operations. This happens when a business sells or eliminates parts of itself for different reasons. So if a company has a product that is outdated and wants to shut it down, they need urgent liquidity, they have a department that's not being profitable and will be closed, or even if they want to close a branch in a specific location. As long as the operations they're eliminating, selling, or holding for sale in the near future no longer have any cash flow impacting the company once dissolved, would be considered as discontinued operations. Now, net income before extraordinary items is what is left after taxes from all ordinary expenses the company had that we have already gone through, like cost of revenue, operating expenses, and non-operating expenses. And down here, net income after extraordinary items, refers to the unusual, unexpected events that might happen incurring losses, like an earthquake, a factory fire, etc. They don't seem to have faced any of these unusual scenarios, but they only have some losses on discontinued operations for $1 million that were subtracted from our net income before extraordinary items for a total of $1.3 billion. Net income after non-controlling interest. Our total doesn't change, so they don't seem to have any either. I'll be making a video in the future about this non-controlling interest metric and how it works, but it's basically a portion from the net income produced by a different company owned by eBay on its majority, meaning eBay owns over 50% of that business. And non-controlling interest refers to the portion of the net income that business generates that belongs to the minority shareholders that still own the remaining percentage eBay doesn't own. We get again to the important number to us, the net income available for stockholders. Notice how volatile it's been. It went from $1.7 billion in 2019 to roughly $5.7 billion in 2020 and peaked in 2021 to $13 billion. And from this peak, the year after, they weren't even profitable, but they lost $1.2 billion. Now, you might be thinking, isn't it good they went from $5 billion to $13 billion? But the thing is that, ideally, you as an investor want a business to generate the majority of its profits from their normal operations. And if you take a closer look for that year, their net income after taxes was in fact one of the lowest. But because they had a huge amount of discontinued operations, as they might have eliminated product lines, closed departments, or just needed some liquidity, this is where most of the $13 billion net income came from, which might also be the reason why they went from that to a negative $1.2 billion last year. And this is actually why gains and losses from discontinued operations are reported separately from net income for continuing operations in the income statement, which is the net income left after taxes, but before one-time events and discontinued operations. This way, investors are able to know the profits or losses that were generated from the business day-to-day operations and the ones generated from operations they have shut down and will no longer represent any gains nor losses in the future. Reviewing their margins, their current gross margin is about 72%, which is actually not bad at all, even though it's been slightly decreasing compared to previous years. And their operating margin is 22%, not bad either. But lately, they've been incurring into a lot of non-operating expenses and losses, creating a big gap between their total revenue and their net income for stockholders. eBay has delivered good results, however, in the last couple quarters, where they exceeded Wall Street estimations, and you can clearly see some difference in the past 12 months with the previous fiscal year. But I would personally give it some time to see how the company continues to perform before considering investing as far as numbers look right now.
So that would be it for the income statement, guys. Now you know what things you're looking for in it and what things you should watch out for. Remember to always review and compare all the financial statements, not only the income statement, but also the cash flow and balance sheet of the same company in previous years or different companies within the same industry and sector. Make sure margins improve over time and that your target company has significant competitive advantage over similar corporations. If you want to get more content like this, don't forget to subscribe and turn on the notifications to keep you updated on new videos. See you.